Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Seana Smith. Let's get into three things that you need to know today. First up, U.S. stock futures under pressure again this morning. The market's already wiped out $2.1 trillion from its February highs amid AI concerns, trade risk, and earnings. Alibaba putting pressure on the tech sector this morning after launching an AI model rivaling DeepSeek. Meanwhile, Marvell's shares plunging, the chipmaker's revenue forecast falling just short of the highest estimate. That's putting pressure on the stock here this morning. Plus, President Trump delaying auto tariffs on Canada and Mexico by a month. The temporary reprieve following pleas from industry leaders. Now, the administration spoke with the heads of Ford, GM, and Stellantis amid the imposition of 25% import tax. Now, President Trump is also considering exempting certain agricultural products from tariffs imposed on Canada and Mexico. And on the retail front, Macy is posting better than expected results, but it did issue a disappointing outlook for sales and profits, citing external uncertainties. Meanwhile, Burlington shares is spiking today after the retailer reported strong results, but the company did warn in the outlook, though, that it is uncertain. Stock futures under pressure again this morning. You got the Nasdaq leading those declines, on track to open the day off just about 1.7%. You have Nvidia and Tesla among the biggest underperformers of the Mag 7 names here amid the sell-off that we're seeing in chip stocks. And Tesla is seeing its price target slashed by Baird. Joining us now to make sense of the tech trade, we want to bring in Dan Ives. He's Wedbush Securities Global Head of Technology Research. Dan, it's great to have you on here this morning. So help us make sense of what is happening here. The selling to you, is that justified or is this a bit of an overreaction?
I mean, look, it's a growth scare, right? I mean, if you look at the tariffs, I mean, the concern is like, what does this mean for the AI trade, chips, export controls? It's added uncertainty. But in my opinion, it doesn't change the demand cycle. In other words, this is not going to end the tech bull market. It's a scare, but I believe it's more opportunities than time to head for the hills.
What is that opportunity, Dan? I guess where is that opportunity?
I mean, look, I continue to think Mag 7, when you look stronger and get stronger in terms of this tech trade. I mean, we just came back from Asia, demand 15-1 for NVIDIA when it comes to next gen chips. That's not changing. So the point is that I think when you're able to kind of go through periods like this, and I get that there's a lot of uncertainty, but just as we navigate tariffs in 18 and 19, and just like we've navigated other macro issues, that's our view. It is the time to own the winners. You look at these names like an NVIDIA. You look at names like Palantir. You look what I believe Apple, which is obviously holding up very strong, and a lot of the other Mag 7, Microsoft, Alphabet, and others.
So, Dan, is this very much more so driven by macro concerns rather than sector-specific concerns?
I think 70% macro. I mean, the worry is like you just don't know rules of the game. So you don't know when you wake up, whether it's US or Asia, what's coming out of the 202 area code. Retaliatory, what does it mean? It adds uncertainty. And obviously, like in the risk-on environment, you've seen risk off. You see what happens in the 10-year. And now you're seeing growth investors just get more and more concerned. But when it comes to tech, even on some of the knee-jerks like a Marvell or, Mongo and others, take a step back. Like the AI trade and the strength is just going to continue to accelerate.
Dan, are those gains, though, capped until we get some more clarity on the macro front when it comes especially here to tariffs?
Yeah, I think it's range bound. I wouldn't necessarily say it's range bound, but it does speak to our view that like, this is all a game of high stakes poker. If you think tariffs are going to continue and you start the trajectory out when it lasts through 2026, then all bets are off. But as we all know, I mean, this is all a game that ultimately is about negotiations. That's how Trump goes about it. And, my view is being in DC, called 3-4 weeks ago, and even, being in Asia, my sense is like cooler heads prevail and you're going to get to deals. And I think a lot of this is ultimately going to be bark worse than bite, but it's nervous. And that's creating this sort of angst and white knuckle period that we're seeing.
Dan, I'm curious, how would you assess, or what is your assessment so far of the tech industry's approach here to the Trump administration? There's a report out this morning that tech leaders are going to be meeting once again with Trump's administration next week. What do the next several years look like here under this administration?
Look, it's embracing, right? I mean, much different than sort of arm's length and almost, much more of a negative view in terms of first administration. Look, I think there's a few things. One, for the first time in 30 years, tech's leading, in US versus China because of AI, because of the trade, because of NVIDIA, because of ultimately what we've seen in terms of the AI revolution really being a US story, right? Even when it comes to DeepSeek, obviously the Singapore story and everything else, you realize like, that was a lot different than maybe what initially thought. When it comes to Europe, I think there's a view like they're done with the big brothers watching. Like they want US to have much more strong arm tactics in terms of some of the frustration that tech companies have faced. So I do think it's much more of an embracing of the Beltway and Trump administration, especially relative to what we saw in Trump first administration.
Dan, let's talk about what is going on on a global scale, because you have Alibaba launching potentially this DeepSeek rival. That's obviously causing some ripple effects here in the markets this morning. I'm curious, is it a threat to US's AI dominance?
See, I don't view it as a threat just because it always goes back to DeepSeek, 6 million not using next gen NVIDIA hardware. I mean, that the same chances that I'm playing in the NBA this week, right? So the reality is that Baba, we're bullish on Baba. And I don't view it as necessarily a competitive threat because it's just a matter of time till Apple and Alibaba partner. And ultimately, Bob is going to be Apple's partner when it comes to AI in China. Innovation is going to continue to increase more and more. These models, more enterprise going down the path, whether it's China or US. Export controls will be there, but the reality is there's only one chip in the world that's fueling AI revolution. It's Godfather of AI, Jensen NVIDIA.
Dan, outside of the Mag 7, outside of names like NVIDIA, what do you like?
I think it's in software. I think you look at name of Messi of AI Palantir, you look at Salesforce.com. I think Mongo is selling off like this is a huge opportunity. Look at names like Snowflake. I think more and more software on the use cases is going to be the ones that benefit. And again, I think we're going to look at this as a growth scare, but not something that dramatically changes our view of the trajectory where tech's going next few years.
So, Dan, it sounds like you're buying the dip here.
Oh, I think but look and that's been our playbook, for decades. Like it's easy, the macro, right? It scares you. And then you look back and be like, why not own the winners? Why not own the dip? But it just comes down to like in the chaos creates opportunities, and that's our view.
All right, Dan, always great to get your perspective. Thanks so much for hopping on with us here this
Thank you.
morning. U.S. automakers have been granted a 1-month exemption from tariffs after administration officials spoke with industry CEOs yesterday. Those tariffs would have raised the cost of a new car potentially by as much as $12,000. That's according to analysis from the Anderson Economic Group. Agriculture products, they could also earn an exemption soon. That's according to the latest from the U.S. Agriculture Secretary. But there are more tariffs to come potentially. Steel and aluminum, they're scheduled for March 12th. Reciprocal levies are set to begin next month on April 2nd. Joining me now to help make sense of this is Paul Krugman. He's a Nobel Prize winning economist, also author of the Substack, Paul Krugman. Paul, it's great to have you back here with us. So I'm curious, obviously we've been talking a lot about this week, the threat of these tariffs or the follow through that we've seen of the tariffs, how big of a risk this poses here to the U.S. economy. What do you think?
Well, it's a huge risk. I mean, the tariffs on Canada and Mexico, if you had to choose among places to have a trade war with, that would be kind of the worst because we have, there really is no such thing as U.S. manufacturing anymore. There's North American manufacturing. It's a deeply integrated manufacturing complex that sprawls across both our northern and our southern border. And here you have, yesterday, tariffs announced that are hugely disruptive to these very complex supply chains. Now we have a month pause, but in a way, this on again, off again, who knows what tomorrow will bring is almost worse than just having the tariffs. I mean, think of yourself as a auto company executive trying to plan. If you knew that we were going to have these tariffs, then you start a crash program to try and unwind the interdependencies among production among the three countries. But then maybe we don't have the tariffs, or maybe the tariffs are coming next month, or maybe they'll be on again and off again, and that just freezes you in position. This is almost pessimal. It's almost the worst thing you can do is to have destructive tariffs that may or may not happen.
Is there a winner in a trade war?
It's really generally not. I mean, trade, the reason we trade is that trade is mutually beneficial. We trade, if you look at our trade with Canada, first of all, there's a lot of economies of scale in not having separate plants for separate markets, so that we can do a lot of specialization. A lot of what we buy from Canada, we have a trade surplus with Canada outside energy, but we get oil and electricity, hydropower from Canada, and that's beneficial to us because they have the resources. It's beneficial to them because they earn stuff. So a trade war that disrupts all of this just raises costs, increases inefficiency. Trump has managed actually to have tariffs on manufactured goods that will probably reduce manufacturing employment, because so much of what is involved here is actually inputs. We're talking about auto parts, we're talking about steel and aluminum. These are things that are actually going to raise the cost of manufacturing in the United States to an extent that it does more damage than any protection you get from foreign competition.
Paul, it's really interesting. I guess when you're thinking about the effect on employment just beyond the auto industry, what do you think that could look like?
Well, the general rule is that in the medium run, employment's going to be what it's going to be. It's determined by the labor supply, and the Fed will do whatever it takes. If we're thinking about the short run, I think that the uncertainty that we're creating here is the dominant thing. I mean, if you have a business that has any kind of investment plans that depend on what the trade policy regime is going to be, what are the tariffs going to be? Who are we going to be having a trade war with? Because, the EU is probably next in line. What you probably do is pause. You sit on your hands. Why commit to an irreversible investment when you just don't know what the environment is going to look like? So that is, I still don't think a recession in the U.S. is the most likely case in the near term. But if you were going to try and set up conditions for one, this would be it.
Paul, how are you thinking about some of these retaliation measures? And I bring that up on the heels of some of the commentary that we got from the CEO of Brown-Forman yesterday following their earnings. And he was talking about the fact that Canada is actually pulling U.S. alcohol right now from their shelves is, quote, worse than a tariff in his view. So I guess putting that into context and adding to that uncertainty here for U.S. business leaders, what does the ripple effects of that potentially look like?
Oh, sure. I mean, first of all, the United States exports a lot to our neighbors. Right? We do run a trade deficit with both of them, but that doesn't mean that we don't have a lot of sales there. And ordinarily, you would say the calculus is the U.S. is a big economy. And so even if there's costs on both sides, they're much smaller proportionately for the U.S. And so the U.S. is probably, normally you would think that the U.S. would be more ready to hang tough, except that, our neighbors are furious. Booing the U.S. national anthem. Every time that Trump calls the Prime Minister of Canada, Governor Trudeau, he's weakening. He's rallying the Canadian public against the U.S. So it's going to be retaliation. And one thing that I don't think the Trump people have fully realized is that tariffs aren't the only thing that you can do if you're in a trade war. If you're trying to hurt the other guy, to try and force a change in policy. You can also try to restrict exports. The Premier of Ontario has already said he's going to put a 25% tax on electricity imports to the United States. And he says he'll do it with a smile on his face. Now, whether he can actually do that, whether that's happening, whether Alberta's Midwestern oil refineries are very heavily dependent on oil from the Athabasca tar sands. If the Canadians start to restrict or put taxes on those, they can do a lot of damage to the U.S. I mean, Canada will be hurt for sure, but the Canadians are, they're mad as hell and not going to take it any longer. And so this is not a conducive situation for avoiding a lot of damage.
Paul, I want to turn to the White House crypto summit that we are going to see here tomorrow. And I bring that up because you just published a Substack earlier this morning kind of talking about President Trump's plan here for the strategic crypto reserve. And I think it's fair to say, at the minimum, that you're a bit skeptical just in terms of what this looks like, how this will be funded, the point of it. Why are you so skeptical of this effort?
Okay, I've been in many crypto meetings. Sometimes people, trying to understand what it's for, sometimes going to crypto conferences where I'm the designated enemy. Crypto is not a new technology. Bitcoin was introduced in 2009, and we still have no major legal use cases for it. There's essentially no legitimate transaction that you can carry out using crypto. To the extent that crypto is in widespread use, it's almost entirely for criminal activities, money laundering, extortion payments. Why are we doing this? You could say, well, look at the price, and it's true that people have bought crypto and driven the prices way up. But you ask, well, why are we investing in something where it's still not at all clear what the point is, and what does it even mean to have a crypto reserve? It's not like a reserve of oil that you can use if there's a cutoff of oil and we can extract some strategic petroleum reserve oil to fuel the economy. Crypto is just ones and zeros on a computer, and it's not really clear what you do with it. Apparently North Korea has been pulling off some big crypto heists, so I guess we can use it to bribe Kim Jong-un. This is the most oddest thing. We're establishing a reserve of something that sort of doesn't really exist and doesn't have any clear uses, and yet we're going to spend, if Trump can get the authorization, which is not clear, but we're going to spend tens of billions of dollars of taxpayer money on acquiring something that is kind of virtual. It doesn't really even really exist.
All right, Paul, wish we had more time. I'm sure there'd be a lot of pushback from those within the industry. Obviously, looking forward to continuing this conversation in the future. Paul Krugman, thanks so much.
Thanks a lot.
Coming up on Morning Brief, we're going to count you down to the opening bell on Wall Street. Plus, we'll break down earnings from Macy's, also what tariffs mean for the company and the broader retail trade. Plus, Tesla's price target cut at Baird amid plunging sales. We're going to break down that call next. We'll be right back. Now time for some of today's trending tickers. You can scan the QR code below to track the best and worst performing stocks of the session. Some of the Yahoo Finance's trending tickers page. First up, let's take a look at Macy's. They issued weaker than expected guidance for the current fiscal year as it continues its turnaround plan. Yahoo Finance's Brooke DiPalma joining us now with the biggest takeaways. And Brooke, we are seeing a bit of selling here, potentially ahead of the open, off just about 4.5%.
Yeah, that beat on revenue and earnings for the fourth quarter wasn't enough to convince investors because they're focused on three top things right now. Their cautious guidance led to uncertainty among Wall Street, especially around tariffs. In addition to that, the company did miss on same-store sales for the fourth quarter, but investors also keeping a close eye on the improvements that it's seeing within the first 50 stores. Those are stores that it's making heavy investments in when it comes to marketing and more help on the staff level to assist in the shoe department and so on. But that cautious guidance, let's really break that down. For 2025, it warned of lower revenue, profit, and same-store sales growth. Now, CEO Tony Spring did just tell investors on the call that, quote, "We're taking a prudent approach to our outlook, reflecting the external uncertainties that both we and the consumer are facing." Now, CFO Adrian Mitchell went on to tell investors that this guidance that it put out this morning reflects a lot of changes that it's seeing day to day happening with tariffs. It also recognizes the inflationary pressure that it's up against. He did go on to say that it's private brands that it works directly with. It'll be working directly with those factories, rather, of those private brands that is currently developing, with more expected midway through 2025. But for its vendor partners, he said there are a lot of unknowns and knowns. Now, to give some color on what exactly tariffs could look like and the impact that it could have on vendors, according to Budget Lab at Yale, they predict that leather products could see as much as a 10% increase in overall price because of this 20% China tariff and 25% tariff from both Mexico and Canada. Apparel could see an increase of 8%, textiles 6%, and materials like wool, that could see an increase in overall price of roughly 6% as well. Of course, this is a very dynamic, moving situation that Macy's did say that they'll stay on top of. Quickly on that same store sales miss, we did see an increase of 0.2% for the quarter. That was actually the highest quarterly result since the first quarter of 2022, but not enough to encourage Wall Street that this turnaround is working. He said that consumers are still under pressure. They're navigating food prices and the cost of housing, as well as stubborn inflation, and that certainly took a toll on that same store sales growth.
Hey, Brooke, let's talk a little bit more about tariffs specifically. Obviously, it's something that so many retailers are watching. There's also a report out this morning that Walmart is trying to negotiate lower prices with some of its Chinese suppliers, right, as a result of these tariffs.
Walmart, America's biggest retailer here, really setting a precedent for what others could potentially do here. Bloomberg out with a report today saying that Walmart is asking suppliers, the suppliers of things like what they're known for, like kitchenware and clothing. Walmart has reportedly been asked for these vendors to lower prices by as much as 10% per round of tariffs. Now, this goes into Walmart's strategy of that low price model. Walmart spokesperson telling Yahoo Finance this morning that we will continue to work with suppliers to keep prices as low as possible for our customers. In the meantime, we encourage all parties to work towards finding common ground that will protect consumers from price hikes and continue to grow our economy. Now, sources have told me in recent weeks that Walmart could have a leg up in this tariff-heavy environment, given its scale. It has the ability to push back any increases to these suppliers or vendors and manufacturers. And he also said, this source that I spoke with, that if you're a supplier, you don't want to lose Walmart's business.
All right, you certainly don't, just given their size. All right, Brooke, thanks so much. Let's take a look at Marvell. It's another stock that we're closely watching here this morning. Marvell plunging after its revenue forecast fell short of the highest estimates. Now, the chip maker failing to impress investors who were looking for a bigger boost from that continued AI demand. Still, though, the company's fourth quarter results came in above expectations. Madison Mills is joining me now to break it all down. And Maddie, the degree of the sell-off is a little surprising to me here. The fact that we are down 17% in pre-market, given the fact that it was actually a pretty decent quarter here for the company. The guidance wasn't that bad. Yes, falling just short of the highest estimate, but it did meet some of the bar that had been put out here from Wall Street.
That's so well said, Shauna, just in terms of the context here. In last quarter, remember, they had those record-breaking results, bringing the stock to an all-time high. Stifel with a note saying the Marvell report, it just didn't calm nerves about the AI trade, and we've already been seeing that weighing on a lot of these big tech names, obviously the likes of NVIDIA included in that basket of stocks that have been moving to the downside. And Marvell taking some other names with it this morning. Obviously NVIDIA, like I mentioned, but also you've got Broadcom moving to the downside off the back of this print ahead of their earnings results coming out later today. So it is interesting seeing the degree of the sell-off in these chips names. I wonder if, to your point, it's not that there's anything sinister in this specific print, it's just the negative vibes on chips overall.
Yeah, and that's kind of what Dan Ives was alluding to from Wedbush earlier this morning, just that it's a bit of an overreaction maybe this morning. The degree of the selling that we're seeing kind of caught up with some of those macro headlines that have been very much driving some of the selling action that we've been seeing in the market. So tough timing maybe for Marvell too. And then it's also interesting, Broadcom's also under a bit of pressure here ahead of their results tonight. Right. So we'll see how things shake out there. All right, let's take a look at Tesla. It's a top trending ticker here at Yahoo Finance. Their price target was actually cut from 440 down to 370 at Baird. And that's one of the reasons why the stock is lower here this morning. The analyst citing weaker sales data in some of its key regions. Now, Baird also adding that the EV maker as a, quote, bearish fresh pick here when it comes to, I guess, putting that in context, trying to figure out exactly what that means. We're going to have to talk to the analyst, Ben Cowell, a little bit more about what exactly he means in terms of that positioning. But he does bring up a good point just in terms of the fact that the numbers that we are starting to see, just how big of a risk, or maybe this does pose a potential risk here to the Q1 delivery estimates.
Yeah, and it's interesting that he does note that production downtime with the Model Y, which is something that did weigh on their sales numbers coming out of Europe, coming out of Germany, that we have seen moving the stock in a negative direction here. And you can see the stock erasing their post-election gains that we had seen with Tesla. But it's still got a pretty bullish move on the street when it comes to analyst reaction. We've got over 30 buys, 15 holds though, so a little bit of holding pattern for Tesla. I do think it's interesting seeing the call out here from this analyst saying Musk's involvement with the Trump administration does add uncertainty to the demand side. They also added it to that bearish fresh pick, like you mentioned, Shauna. So it's interesting to kind of see the street getting on board with perhaps this question that's been coming from consumers, which is, do I want to own a Tesla if Elon Musk is going to be supported by that purchasing power decision. So interesting to see if that does continue to weigh on the stock.
Certainly will be. All right, Maddie, thanks. Keep it right here on Yahoo Finance. Much more coming up on the morning brief. We got the opening bell when we come back. So opening bell on Wall Street as we kick off a new trading day, a bit of a reversal from some of the gains that we saw yesterday. We are seeing red across the screen for the major averages as we do start and kick off today's trading day here. Some concerns here, obviously, regarding tariffs, but specifically for the tech trade, really leading some of the losses here to the downside. A new AI model that was being revealed by Alibaba. They're calling it a rival here to DeepSeek, at least initially viewed as a potential rival here. That's adding to some of that pressure across the AI trade. More broadly speaking, the pressure across the tech industry. You've got the Dow opening off just about 1%. You do have the S&P also under a bit of pressure once again here this morning, off just over 1.3% here at the open. The NASDAQ, I mentioned some of the heavy selling that we are seeing. Some of those larger cap tech names, you are looking at the NASDAQ opening off here nearly 2%. Flipping over to the bond market, some of the activity there that we are seeing for the 10-year yield, we are moving just to the upside, up just about 2 basis points. It's certainly an important trade to keep an eye on here this week. As we take a look at the NASDAQ 100 on an intraday basis, like I mentioned, a lot of those larger cap tech names under a bit of pressure. You've got NVIDIA off just about 3.5% here at the open. Also some heavy selling in Microsoft, Amazon, Google, Meta, all off just over 1%. Tesla up here on your screen off just about 3.5%. I mentioned the price target cut from Bear. That's adding to some of the anxiety here, but clearly it's a bit broader here when you take a look at the degree of the selling that we are seeing across a lot of these tech names. You also have Broadcom sinking today. That coming on the heels of the Marvell earnings that we got out this morning. Clearly not living up to expectations. Questions going into their print as they report results later on tonight. Taking a look inside the Dow, some of the pressure there with the Dow off just about 1%, but we are seeing selling more broadly speaking. Obviously, other than tech, you've got a name like JP Morgan off just about 1.5% here. Salesforce also off nearly 2%. Walmart under a bit of pressure today. We have retailers really in focus here this week following the tariffs on Mexico and Canada and China, and ultimately what that means for the sector, how big of a headwind potentially going forward. And taking a look at the sector action for today, you are seeing a sea of red. You got technology, the worst performer. Not surprising, given everything that we've been talking about here. Consumer discretionary off just about 1.5%. Financial, some losses there. Did you take a look at a 4-day chart here, just in terms of the degree of the selling that we have seen this week? Certainly we have seen a number of sectors here in the deep red territory. You got financials among the worst performance, technology, and also energy. Jared Blicker has a closer look at some of this movement. Jared.
Thank you, Shauna. Some really interesting things happening in the indices and also the rates markets and the dollar. So let's go through it. We are having the worst start to March. I'm going to put a year-to-date chart on since 2009. That stat comes from Optuma, and you can see the decline here. This was a record high, and it's been not quite straight down, but just a few zigs and zags. So really some underperformance here, and I guess underperformance compared to what? Some homework there. It's also the worst ever start for energy and also tech, and that is ever. You'd have to go back to the beginning of those ETFs. That data starts, 2003, somewhere in that time frame. So really some outsized movements to the downside here that we're seeing in March. Here's a 10-year T-note yield. What's interesting is that rates have been going up for 3 days while the dollar has been going down for 4 days. This is a different dynamic than just a few weeks ago when the dollar going down along with rates, which would tend to be what happened. That was actually bullish for stocks. Now you're seeing investors get out of bonds. That's why rates are going up, and they're getting out of the dollar. So there's just a flight out of U.S. assets, including stocks. So that's what I think we're seeing here. Investors leaving stocks, bonds, and also the dollar. And so that is definitely a different dynamic there that we need to pay attention to. Shauna was just going over the sector action. I don't have much to add there. Tech really leading the way down. As she said, not too big of a surprise there. Chinese stocks coming off of their best day since December. Let's see how they're doing today. That was just a huge day. You can see more green there. If I show you the year to date, that is a sector, or that is just a place which has really seen some outsized gains, and that has been a bright spot amid some of this redness that we've seen over the last few weeks. I got to go over to futures land, where we're seeing WTI crude oil. That is holding, let me put the intraday prices on there. Crude oil is holding at the lowest levels, near the lowest levels that we've seen in 3 years. Here is a chart. You can see it's up 0.6% today, but I'll put a 5-year chart on, and it is right there hugging these levels in the mid-60s. And so if it were to break that, you'd think, well, it should find support at some other level. That's probably closer down to 60. So we could see some further movement to the downside there. And that's something we want to monitor as well. Copper futures, we were highlighting that yesterday. Copper is actually flat right now, but yesterday it just had its best day in quite some time. And you can see here on this 10-year chart, it is at these highs that we're looking at on this 10-year time frame. So that's another important thing to consider as we consider the effects of all these tariffs. I'm going to close here on crypto. Let's take a look at Bitcoin, which is up a whopping 20 basis points in the last 24 hours, and we can see it is steadily holding under 90,000 right now. We've been through a lot of volatility, both to the downside and to the upside and back to the downside, and so it's just kind of consolidating. If it moves above 90.92, that's significant. My line in the sand is 100,000. I think of 100,000, it really needs to clear before we can consider the worst part of this sell-off over. On that note, I'll send it back to you, Seana.
Well, we've got a ways to go to get back there. All right, Jared, thanks so much. Time now for today's strategy session. Trade tensions and growing signs of a growth slowdown prompting a $2.1 trillion sell-off in the stock market. And it's called into question whether or not the recession trade is back. So is now the time to get defensive? Joining me now, I want to bring in Gina Martin-Adams, Chief Equity Strategist at Bloomberg Intelligence. And Gina, what do you think? I guess when you take a look at the fact that bank stocks, you've got small caps still struggling in this environment, the continued selling that we're seeing this morning, is the recession trade back?
Well, I think it's part of the story, certainly, is economic growth has certainly created a bit of downside risk in the equity markets over the course of the last few weeks, as surprises have been negative. The market was definitely not anticipating a bit of an economic downdraft to what was already market weakness that had emerged well earlier in the year. Clearly, the tech landscape has changed dramatically. Tech was responsible for the vast majority of gains on the S&P 500 over the course of the last 2 years. So any sort of downside momentum in tech creates downside in the market, and then that got exacerbated by what we saw in the economic data. In the interim, it does look like the data is going to remain somewhat weak. We've got payrolls coming on Friday. Most forecasters reflecting the downdraft in layoffs that we saw earlier this week would anticipate a weak payroll number coming on Friday. That could take the market somewhat by surprise. I think we're going to go into a period of time where the pressure starts to emerge on the Fed to respond. And that could be very interesting, creating some volatility in rates as well. But in the interim, the answer is yes, the trade is on, and it's on to the downside, in part because our confidence in the growth outlook has been depleted over the course of the last few weeks.
Gina, what would trigger the Fed to act? What do you think the Fed needs to see in order to feel comfortable cutting rates?
Yeah, the Friday is going to be a really interesting day. So tomorrow morning, we may actually see a downward decline or a big decline in employment concerns. If the employment generally drops, if the unemployment rate rises, that is one of the indicators that the Fed follows fairly closely. So if we see growth really deplete the outlook for jobs, that could create a response of the Fed. I think it's a bit early to say that 1 month will create a response, but the pressure will start to emerge. If we start to see more initial claims rising, if we see those layoffs continue over the course of the next several months, if we see this accumulate into a job distress environment, that's one leg of what the Fed is responsible for monitoring. So if we start to see growth to really truly decline on the employment lines, then the Fed may respond. That, of course, also leads to what's happening with inflation at the same time, because, of course, the Fed has a balanced view of growth and inflation at any given time. Will we start to see inflation moderate? Because that may be the secondary key. If growth is decelerating and inflation is decelerating, then the Fed has a lot more room to act. I think it will take a couple of months, but this Friday may be an initial trigger that the Fed really has to start to pay attention to.
Is it safe to say at least some of the volatility that we started to see creep back into the market, that's here to stay, just given all that uncertainty and given the fact that we don't know necessarily, obviously, the timing of the Fed, whether it's going to act, and then the risk here that some of this econ data continues to get worse?
Yeah, the volatility is several-fold. It's not just economic data and the Fed, as you rightly point out, but it also is about earnings. Earnings confidence has been depleted. Clearly, there are competitors in the tech space. The race for AI is now a global race, not really a U.S.-led race predominantly anymore. It really is global. The result of that is competitive pressures emerging for tech. We also are seeing downside estimate revision emerge across the entire S&P 500. So beyond tech, with the exception of financials, every other sector has also produced a negative estimate revision. I think broadly what happened was we came into this year with just too high of expectations. The market was priced for near perfection to emerge in the economy as well as the earnings stream. We are now really questioning those assumptions, and that's creating the volatility at large.
Gina, let's talk about this from a global perspective. You have said that the Mar-a-Lago Accord, that intentional devaluation of the U.S. dollar, an idea that has been floated from some of the key advisors here to President Trump, that it could actually be rocket fuel for a global stock disruption. Explain that to us and exactly the risk potentially that this entails.
Sure. So we looked at former currency accords like the Plaza Accord and the Louvre Accord from the mid-1980s to do some of this analysis. We also look at the correlation between the dollar and global stocks. And what you find is in the Plaza Accord in mid-1980s, the dollar was devalued, especially versus the biggest currencies that contributed to the dollar's gains. So that at the time was the German Deutschmark, the French franc, the Japanese yen. The result of the Plaza Accord was a very sharp devaluation of the dollar, but it also was a rotation into non-domestic equity markets. In particular, the Japanese equity market soared in the time in which the dollar was depreciating. The Louvre Accord came shortly after the Plaza Accord, about 18 months after the Plaza Accord, in an attempt to stabilize the currency markets at that time because the dollar was so rapidly depreciating that it became a destabilizer for global financial markets. At the time, the yen continued to depreciate relative to the dollar, but the Louvre Accord allowed for some stabilization in the European currencies. That did change equity dynamics. But big picture, when the dollar is declining, international equities tend to outperform. We see a long-term correlation that is relatively meaningful there. So if we go into an environment where the dollar is decelerating, you can anticipate that the most likely outlook for global assets is for a continuation of the rotation into non-domestic stocks. So far this year, we've already seen European equities dramatically outperforming rest of world equities. We've seen Chinese equities start to perform significantly better as well. The U.S. has taken a big backseat now in the bottom third of countries in terms of performance so far this year. That may be amplified by something of a currency adjustment, potentially call it a Mar-a-Lago Accord, or even just a currency adjustment that occurs organically in the global equity markets would largely favor those non-domestic equity markets.
All right, Gina, thanks so much for breaking that down for us here. Gina Martin-Adams of Bloomberg Intelligence. Always great to talk to you. It's time now for our chart of the day. After 2 underwhelming years, low volatility stocks have actually become one of Wall Street's top performers. Madison Mills has a closer look. Maddie.
That's right, Seana. Taking a look at a little bit of recession risk coming into the market here, and one example of that potentially is the huge success we've seen in low volatility stocks having their best outperformance versus the S&P 500 that we've seen in years. So at this chart behind me, you can see the underperformance of the S&P 500 down about 5% from its last all-time high. And then you've got the outperformance of these low volatility ETFs that are up nearly 4% since the start of the year here and experiencing record-breaking inflows to the upside, leading to these gains that you are seeing. Now, as I mentioned, this is part of a little bit of a momentum unwind that we are seeing and perhaps a recession risk trade that is developing on Wall Street, because it's not just low volatility stocks that we're seeing inflows into. We're also seeing outflows from the likes of bank stocks, inflows into consumer staples that are seen as potentially recession-proof because you need some of those consumer staples. They're not necessarily wants. At the same time, you have the Russell 2000 small cap stocks still underperforming off the idea that the Fed may be unclear on interest rate moves moving forward. And investors are still, of course, sussing out where the market is heading. Is there a fundamental shift in the market that needs to be digested even more, which would push the S&P 500 down potentially even more than it is right now? Or is this just a moment of economic slowdown, a little bit of slowing before slowdown rather, and confusion as the market digests the impact of all of that policy from the White House, Seana?
All right, Maddie, thanks so much. Well, coming up, we are taking a look at what's ahead for automakers after President Trump paused tariffs on the industry for at least 1 month. We'll break that all down when we come back. U.S. automakers giving back some of yesterday's gains. You're looking at losses here across the board. You've got GM off just about 4%. Now, this comes following the Trump administration's exemption here, at least for U.S. automakers, for at least a month on the new tariffs that have been imposed on Canada and Mexico. Let's talk about the threat that this still potentially poses to the industry, given some of that uncertainty at this point. For that, I want to bring in Dan Ruska. He's Bernstein's senior analyst. Dan, it's great to have you here. And I know you've been extensively digging into this, modeling this out, exactly the implications of what this could be. The fact that we do have a month reprieve, yes, maybe that is alleviating some of that concern, but still, what is the risk here posed to some of these largest automakers?
Good morning, Seana. Yes, look, the U.S. auto industry is about an industry of 750 billion revenues, to put this into context. And if there really were to be 25% tariffs on Mexico and Canada, that would take about 40 billion of extra cost into the industry and basically reduce the entire profit margin of the North American auto sector.
So I guess put that in further context, just in terms of that downside risk, exactly what that poses then to these three names.
Well, on the three names, you would likely see a severe deterioration in annual profits, probably zero at the end. Mm-hmm. And there would be a large supply chain reorganization required if those tariffs really stayed into place. I think that is one of the reasons why both the market and the industry have been assuming that these tariffs, to the extent of 25%, would be postponed, and if they really come into effect, would only be in effect for a couple of weeks, because anything beyond that would be severely detrimental to the North American and U.S. auto industry.
The supply chain disruptions, that threat, Daniel, what does that look like? The ripple effects of that when you talk about free cash flow impact, I guess how bad of a hit could we see there?
Well, free cash flow will probably be cut by half, if not more. I think the greater risk is actually that way down in the supply chain, somewhere in the tier 3, 4, 5 supplier category, you'll have some suppliers that will have to pay tariffs within 8 days, but only receive their money from their customers after 60 to 90 days. And so there's a severe risk that we will actually see bankruptcies of small parts, and it'll be the whole chip crisis, the supply crisis we saw during COVID, all over again, with the difference that while prices for cars would rise, cost would rise as well. And so there isn't really a profit upside in that supply scenario.
You know, Dan, that's very interesting. I guess when you talk about that, just the sheer ability for these automakers to even be able to pass along higher costs to consumers at this point, given the amount of pressure that consumers are under because of inflation, to what extent does that even handicap the automakers at this point?
Yeah, it depends a little bit on the segment. If we think about different segments, the exposure to Mexico and Canada is different. So if we think about your Yukons, right, your large SUVs, the majority of those are made in the US, actually. They do import a lot of parts from Mexico and Canada, but it's likely that OEMs would try to pass those costs on to consumers, which in turn would have a little bit of a volume hit, but might safeguard some of the profitability. And then there are other segments where you still import a lot of cars from Japan or South Korea that would not be hit by tariffs at all. And there, South Korean or Japanese manufacturers may actually have an advantage over North American producers or US producers like Ford and GM and gain market share during that.
You know, Dan, there was a story out this morning, Stellantis trying to bring back more production potentially here into the U.S. You mentioned the supply chain disruption, what that looks like. Just walk us through the timeline of this and how tough it is for these automakers to move some of their production back here to the U.S., just in terms of the complication factors and also just the fact that it takes time to build these plants.
Yeah, so number one, I mean, everybody's been pre-building inventories. And so I would argue that a couple of weeks of tariffs is something the industry can sustain with some downside, but it wouldn't be, it would not be the worst case scenario. If this really extends, the difficulty becomes you can reallocate some production. Let's say you have a car you produce in the US and in Mexico, shifting that then to the US, expanding a little bit the production capacity in the US on the margins in individual cases is possible. But I simply do not see how any executive right now could make a decision to build a $4 billion plant for for 200, 300,000 more cars in the US, with the uncertainty that even if the tariffs stay on now and maybe next month, will they still be around in 4 years' time, in 10 years' time? Because these plants are built for decades. And so I think the bigger long-term risk here is actually that the uncertainty of the current situation prevents any decision that on investments in the US ultimately. And I don't think that the constant back and forth without a policy really helps to make decisions for the long term.
Dan, I only have about 20 or 30 seconds here, but real quick, Tesla obviously been under pressure here, a number of factors. One of those, though, calling into question some of that demand. What do you think that looks like from an industry perspective, if we're able to extrapolate anything from that?
Yeah, I think the demand has been falling for Tesla in the US, but also internationally. You saw European values come in really badly. So I think there's a headwind right now for Tesla. And Tesla is also not immune to the tariff situation, because for some models, they import up to 50% or more of their parts from Mexico.
All right, Dan, great to get your insight. Thanks so much. We'll be right back.
Shauna.
The White House set to host its first crypto summit tomorrow on Friday. Here with more on what to expect is our Fed correspondent, Jennifer Schomburger. Jen.
Good morning, Shauna. Executives from the biggest crypto firms are set to gather in Washington at the White House on Friday for the first ever crypto summit hosted by President Donald Trump. Among the attendees, Coinbase CEO Brian Armstrong and MicroStrategy's Michael Saylor. Also expected at the event, AI and crypto czar David Sachs and Bo Hines, executive director of the Presidential Working Group on Digital Assets. The expectation is for a formal announcement of a U.S. strategic cryptocurrency reserve. Sachs tweeted on Sunday, quote, President Trump has announced a crypto strategic reserve consisting of Bitcoin and other top cryptocurrencies. This is consistent with his week one EO. The president said the reserve would include more than just Bitcoin, listing Ethereum, Ripple, Solana, and Cardano. The Presidential Working Group, led by Hines, was tasked with delivering a report evaluating the creation of a national crypto stockpile and criteria for establishing it by late July. The first step is tabulating how much crypto the government already has through seizures from criminals and other means. From there are questions about how this could be put together and safeguarded from hackers. Technically, the president can take a step toward a stockpile by stopping any selling of seized crypto assets already managed by the U.S. Marshal Service. But to make the reserve permanent or include a purchasing program, an act of Congress through legislation is the preferred route. Back to you.
All right, Jen, thanks. Well, that does it for this morning's brief, but keep it right here on Catalyst. Coming up next.